Welcome everyone to the second session. We have two presentations. First one is going to be given by Jennifer. Bruno, I understand, is in Italy. I don't know why, because we have Italian weather today. Right, laws of demand, role of state regulation in pension fund asset allocation. So 20 minutes,
yep,
then discussion, and then we'll go into the second session. All right?
Okay, thank you very much, Lotus. Apologies from Bruno. This is a collaborative piece of work between me and him. We've produced a paper which we're happy to be sent around to everyone. It's just a working paper. I'm quite pleased, in fact, with the fit of what's gone before with today. It's perhaps, in hindsight, a little superficial given the knowledge base of the audience, but it hopefully will add something to the discussion. So, the purpose of the paper really is to give the point of view from the pension funds themselves. So we'll just be talking a little bit about how they have been conceiving the risk situation themselves, the sponsors and the funds themselves, and also we'll be talking about regulators and what they have been doing in terms of managing what they see as increased risks in the sector. So we start off just with a discussion about pensions. So it's a little quote I quite like. I don't actually know who Mike Davis is. I don't know if anyone else does. This was on the back of a Robin Blackburn book on pension funds. If Karl Marx were alive today, he would be devouring everything he could find on pension funds. I'm not entirely sure I agree, but Bruno and I do agree that pension funds are large, they're growing, they obviously have an impact on the functioning of capital markets and therefore on the financing decisions of firms and therefore on the economy more widely. So obviously they do require our attention. Now, what we're going to be talking about is this idea that there is a broad desire to de-risk the sector. So there is a broad move away from the equity asset class towards alternatives, and this is where we get the link to shadow banking. So that will be what I talk about first in the presentation. And then secondly, there is now growing debate about the appropriate type of state regulation on the question of pension fund solvency. So again, I thought that might be interesting for us to consider today. Bruno and I, it's not either of our area of expertise, but having looked at this work for this paper, it strikes us that new different risks are actually being introduced into the system in a sort of ironic fashion, given that all of the behaviour is an attempt to eradicate risk. So if I start from risk from the inside, if we give a little bit of context about pensions and what they've been doing for the last 15 years, up until 15 years ago, pension funds were very much following a very similar pattern, particularly in the countries where occupational pension funds were a large part of the pension system in all. And so occupational defined benefit or defined contribution funds were mainly consisting in equity, very large in equity in the countries such as the US, Canada, UK, and the Netherlands in particular, which is what we are going to be looking at today. The point of this slide is to say that there was a bit of a cultural myth that came up about pension funds and their link to equity. So the idea was you could have a pension fund socialism whereby the workers would eventually own the means of production by holding the equity of the firms they worked in. This was never going to be very likely to happen. Really, the extent of the power of the pension funds over the decisions of the firms was always fairly minute. So, like I said, this was a bit of a myth. But what happened to break the honeymoon with equity? Obviously, we have the period of the dotcom bubble. So, after a period of meteoric rises in stock prices, which were caused by a general suspension of skepticism about the economic potential of all things internet, alongside what we've been talking about today already, the general capital market inflation of more and more money going into pension funds, we have a sudden collapse in equity, which caused rather a large amount of disconcert amongst the pension fund industry. They all had various levels of regulation to ensure they had a funding level that they could meet, and all found that they were struggling very seriously on their asset side, they were also struggling on their liability side because they were struggling to get any returns, I'll get to that in a minute, on their bonds. Now, if we have a look here, this is just a basic portfolio of a pension fund. So pension funds and their sponsors, it's key to note that there's a key split of agency in this industry. So you have the pension funds themselves, you have the sponsors, you have the investment experts that they are required to listen to. So it's an interesting world. But anyway, the whole world, they've been acting to correct the problems that they've been seeing since the crash in equity prices. So as one example, the pension plan sponsors have been considering that the cost of defining defined benefit plans have been too high. And so consequently, as is well known in the media, there's been a shift towards defined contribution arrangements. Now, the difference, of course, is that in defined contribution, the individual bears all the risk of a fund not performing. So you don't have to promise a certain level of benefit for your members. You simply give them what the fund has managed to achieve during their years of membership. So at the moment in the UK, only 14% of defined benefit funds are still open to new members. There's been a complete crash in the system. So another change that we've seen relates to the funds themselves, which is what this slide relates to. So the asset allocation and investment strategy of pension funds has been changing significantly over the last 15 years. So moving away from a portfolio that was very largely monopolized by equities, the new asset allocation seeks to deal with volatility and potential big losses, both in equities, and to try and do something about stabilizing your liability side. So you split your portfolio into your growth-seeking sector and your liability-matching sector. Now, pension funds have always done this, and as they mature, you have much more emphasis on your liability matching. You don't want to have a big shock as your pension fund matures to find that you can suddenly no longer meet the liabilities that are coming very quickly. So the new ideas within pension fund management is something called liability-driven investment, and what this means is much more focus on the liability matching side of your portfolio through all stages of maturity. And it also means investing in different assets such as various derivatives which will help you hedge against longevity concerns or interest rate risks, which would make your liabilities very volatile. So there's a shift in assets. Now, these techniques are being adopted in quite a big way. So over the last year even, there's been a 29% increase in people signing up to firms who are specifically offering LDI management strategies. Now, can we see a shift in the data? Well, I mean, this shouldn't be new information for everyone. There is a massive drop in the equity share of pension funds. This, like I say, covers Canada, the Netherlands, the UK, and the US. So it goes from 2001, takes it up to 2013, and this is largely the work of Bruno to try and get these figures together. What does it mean if you're dropping the equity? Well, what are the firms going to be holding in place of equity? Well, they may be shifting to debt, but if you look at the fixed income share, it's not taking up the slack of the equity drop. Now, this shouldn't come as a big surprise, because we know with quantitative easing, obviously the price of debt has gone up, and therefore it seems like not a very good value asset for pension funds to go into. So they're attempting to de-risk. They want to worry about their liabilities, but they still need growth. So with yields on government bonds at an all-time low, they are in fact moving into alternatives. Now, this is quite a jumble of data, so we're just calling it other. But this is quite interesting to see where the asset allocation decisions are going in pension funds now. So this is where the search for yield shows itself. So alternatives. So to summarize, the allocations to equities since 2001 has dropped sizably. direct bond allocations have only marginally increased, and so therefore we're seeing quite a big increase in the other part of the portfolio. Now, what is this other? It includes mutual and investment funds, but it's also including alternative assets, which is what I want to turn to. Now, the alternative class includes all types of assets that are simply not traditional securities. So you have hedge funds, private equity, commodities, infrastructure. These can be accessed directly, so you could invest, a pension fund can invest in an infrastructure project, but more often you invest in a fund, and then through black arts of some form or other, that fund will be linked in some way to what it says on the tin. So alternatives are considered growth assets. This is the key point, but they have different characteristics to equity, which is what makes them so appealing to pension funds. So the promise is they will grow, but they don't correlate. Their prices don't correlate with equity. So if you have a crash in equity prices, you can hope that your alternative part of the portfolio will maintain its value. And when your alternative crashes, alternatively, your equity won't be. So the idea is you have this magic solution for pension funds whereby you continue to get growth, but you have less risk. So it's a win-win situation. And there is historical evidence to say that these two prices don't correlate with each other. So where specifically is the money going? Now, this is a sort of million-dollar question which I'm not able to answer because the publicly available data is not great. Now, I want to talk about just one specific example because this is where I have been drawn into this project. This is very much Bruno's research, but I happen to have sat on a pension fund from 2010 to 2014 as a sponsor, not as a fund manager. So we took a decision to move to increase our allocation to the alternative class, and there was a big discussion amongst us about what did that mean, what should we actually put our money into. And now I was arguing that we should put our money into infrastructure, but it's not easy when you're a small fund to find an appropriate vehicle because you're not likely to be able to directly fund a project from beginning to end. You would need to have some kind of staff, some management to oversee that. So you're looking for funds, and infrastructure funds are not good value at the moment either. So if you have a look at this is the local government pension scheme in the UK. So this covers, what have I got? This is £133 billion worth of funds covering local government employees in the UK. Now the share going to private equity, 46%, hedge funds 35%, and you come down, the share for the remaining categories are all equal, but as you'll see, they're pretty insignificant. Now, I just think it's interesting to raise because there's a second pension fund myth, which is about pensions existing in order to meet our infrastructure needs. Now this talks about the idea that as states decide that they cannot become indebted and cannot afford to pay for infrastructure themselves, then pension funds can step onto the breach and cover this cost for us. So this is perfect for neoliberalism because pensions can draw back the need for state revenue expenditure by being private pension funds and stopping the need for public pensions, and then they also come in on the capital side of the state and they pay for infrastructure, so the state can just sit pretty whilst pension funds solve all of our problems. But unfortunately, as you see from the facts before, this isn't where the money's going. The money's going into hedge funds and private equity. Now, hold on one second. Now, if we go back just as a historical, some historical lessons we can draw from when pension funds previously decided that they desperately needed to search for both growth and for sort of a novel attitude towards risk, then we can of course look at what happened in the United States and the link with pension funds in subprime, which very much accords to what we're saying today about pension fund demand being a key part of the puzzle. So if we have a look at this particular example of a search for yield, you have the US Department for Labor restricting pension fund investments in an attempt to curtail risky behaviour. So they say pension funds have to focus on assets that are judged AAA by the credit rating agencies. So you have a great need for low risk assets that are high growth, and hey presto, the assets suddenly come into being, which looked great at the time. But now we know, the role of credit rating agencies in the subprime fiasco is well known. They faced paltry levels of supervision themselves, and so despite their pivotal role in managing the risk of the entire process, they had a huge conflict of interest because they earned money from both the buyers and the sellers of the assets. And the risk models that they used were wholly inadequate, so they placed all the emphasis on producing this risk metric, and there was no consideration of the evidence base that they used in order to create that metric, which is not looking into what Keynes would call the weight of the probability. Anyone who knows their treatise on probability. So we have arguments every now and again about whether Keynes did say anything useful about the financial crisis, and I think this is it. I think this is the one very important bit that Keynes did warn us about before it happened. There was insufficient concern with the metric, and the rest is history. So if we have a look, it wasn't unknown at the time that pension funds were a key part of this puzzle. So I just want to take a look. I know it's a long quote, but this is from the World Bank. Now, this is a very significant publication that came out in 1996, where the World Bank desperately started promoting private pension schemes in all countries, no matter what level of development. So they thought they would be great for emerging markets, for developing countries, for highly developed countries. So it says here, in the US, pension funds and life insurance companies became the main forces behind financial innovation after 74, which was ERISA. New instruments have been tailored to the needs of pension funds, such as zero-coupon bonds, collateralized mortgage obligations, mortgage-backed securities, blah, 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 blah. These financial instruments have transformed illiquid loans into highly liquid and tradable securities and enabled new forms of risk-sharing, facilitating both business investment, and housing finance, which is a reason for encouraging private-funded pension plans in middle-income, developing and transitional countries, so they can become an instrument of financial innovation and financial deepening. Now, there hasn't, as far as I'm aware, been a secondary comment after the subprime crisis about thinking again about what pension funds might be able to do for your country. But here we go. So, move on to the second part of just the second issue to bring to your attention, really. So, the view from the outside. What else has been happening? Bear with me. Let me go back. If we think about what has happened, what are the likely consequences of this big move into alternative assets? It's concerning for all the reasons that we've seen, the more detailed insights that Fotis is giving us about what specifically pension funds are holding. It's a murky world. It becomes very difficult for people to ascertain exactly what pension funds are doing, what they're holding. The demand for bonds can exceed their supply, which is a difficulty for the markets. Governments, of course, are under the pressure to reduce their borrowing, so the quest for de-risking becomes even more daunting in this type of situation. And what else did we want to say? The exposure to private equity and to hedge funds is something that is raising concerns even with the IMF. So the Financial Stability Report of 2013 and 14 both raised this issue. So in 2013, the IMF raised the issue that the solvency of pension funds was being seriously tested by low returns on assets, and that this strain was encouraging the rise of allocations to riskier asset classes. And then in 2014, again, they say the search for yield, which began around mid-2000s, is accelerating flows into hedge funds and private equity funds and stimulating the rapid growth of structured finance and investment funds. So we do very much have the situation where there is a huge demand for a specific type of asset, and the assets are being created in order to meet that demand. So I would very much agree that this is a demand management issue if we want to get on top of it. So there is one interesting point. the Austrian finance minister, Schelling, has said that pension funds are themselves distorting the lending market because they face different regulation to banks. And so we wanted just to pick up in our final remarks about the question of whether or not pensions should face similar solvency regulations to banks themselves, which is being discussed in Europe. Now, how much time do I have?
Say 5, 8 minutes.
I might take less. I've got a whole lot of stuff on accountancy rules, but I think it's too dry. No, it's too dry. I'm going to skip it. I wanted less time, so I could skip it. Tell Bruno that I meant to include it, but I just couldn't possibly do it. So, okay. So blah, blah, blah. There have been changes to accountancy rules, and they're not helping. There you go. This is just an interesting graphic I found late last night about, it's not even the difficulties that the funds themselves face. This is sort of the hit to net income of large firms who have changed their accountancy methods just for their pension plans. So it's an interesting correlation. But anyway, I wanted to talk about solvency particularly. So a lot of countries have taken different routes to ensure the ultimate solvency of their defined benefit systems where they retain them. So in some cases, there's been a tightening of links between assets and liabilities in the long run, but at the same time the funding and accountancy regulations don't impose a perfect match in the short run. So in the UK, this is a bit dry, but someone might find it interesting. The accounting standards require the use of AA corporate bonds to count as discount rates in line with IAS 19 regulations, but the actuarial funding ratios are calculated every 3 years, and they take into account expected returns on the assets. So there is a bit of a discrepancy, and so in the UK at least, the new regulations are increasing the awareness and costs of your liabilities, but there's considerable flexibility still in how to face them. And so in these circumstances we have in this country a pension protection fund, and the way it works is the worse your funding level, the more you have to pay into the protection fund. The US have a fairly similar system as far as I understand it, but in some northern European countries it's a bit less lenient, so you'll have shorter recovery periods. So in the Netherlands, for example, you have to have a 5% buffer margin. You're not allowed any lenience whatsoever. So you 5% buffer margin of assets over liabilities, and your recovery period is only 3 years long. And in Norway, underfunding requires immediate action. And so to link with what we were saying before about specifically banks matching pension funds being brought into line with banks. In the Netherlands, they're trying out regulation where you have to have capital buffers and different assets in the same way as banks. Different assets have different capital buffer requirements depending on their impact or their perceived impact on the riskiness of the fund overall. So assets that are less risky and less correlated with other assets in the portfolio bear lower capital requirements. So this is in common with similar requirements through Basel III and Solvency II. And there's discussion, this is just in the Netherlands, but there's discussion across the European area as to whether this would be good for the area as a whole. There's a massive fight back from the pension fund industry, who all considered that it would be truly awful. And I'm not necessarily, to summarize, to conclude, Bruno and I actually, I think, on the side of the industry in this one, because at the moment pension funds can act as fairly anti-cyclical players in the capital markets, which is through their mechanisms of asset allocation. They tend to take the decision every 3 years or so, so they'll have a certain amount of proportion of their assets in equity, for example, and then if there was a massive boost in equity prices, then they would automatically be selling those assets so that they could maintain their asset allocation that was set 3 years ago, as it were. Whereas if you introduce the same level of risk metrics that you have in banking, you'll have exactly the same pro-cyclical behaviour that everyone's worried that you'll have in banks. Thank you.
Thank you, Jennifer.